Good day, everyone. I'm Michael Chang, Chief Investment Officer, Fixed Income at RHB Asset Management. Thank you for listening to this podcast. To continue on with my podcast previously in mid-March 2021, we will start off with a recap of US Treasury and MGS yield movement on a year-to-date basis. In this chart, we saw spreads tighten for 10-year bond yields between US and Malaysia. Yields were at 175 basis points, have now tightened to 151 basis points as of 5th May 2021. This decline in spreads was led by lower MGS yields from the high of 3.5% mid-March 2021 to its current levels of 3.11%. For US, yields were fairly unchanged and remain range-bound and still hovering around 1.6%. We highlighted back then that valuations were undemanding for MGS when it was hovering at 3.45% to 3.50% and should look at adding MGS at that point of time in mid-March 2021. You may ask, why has MGS yields declined significantly for the same period? This is mainly attributed by FTSE Russell's decision to maintain Malaysia in FTSE's flagship bond index, better known as the FTSE Russell World Government Bond Index, or WGB in short. This announcement is significant to the local bond market as well as to offshore bond investors, as it adds more certainty in terms of MGS' latest status, which is also being tracked by passive fixed income investors around the globe. Onshore and offshore investors have bought up MGS. As with any economy in 2021, most countries are expected to benefit from low base effects of 2020 because most economies were struggling in 2020's GDP. For Malaysia, GDP for 2021 is likely to reach 6%, with the expansion in 2021 to add around plus 2% and likely another plus 4% from base effects of 2020. This is assisted by international oil and gas prices, which has maintained gains, and Malaysia's key trading partner China remains on the mend. The distribution of COVID-19 vaccines outside Malaysia is also picking up speed, which should support external demand. However, there are still risks to this growth trajectory, with Malaysia's recent reimposition of movement curbs in May, although deemed as less severe than before, and noting that businesses in all sectors will likely continue to operate at specific hours. Balancing this risk of targeted lockdowns, we'll continue to see rollout of COVID-19 vaccines in Malaysia in hopes of bringing infections under control and that the current outbreak is temporary. The Federal Open Market Committee (FOMC) on 29 April 2021 broadly met expectations by sticking to only refinements of its inflation and growth assessments in the April post-meeting communique. Fed officials welcome an accelerating recovery that is now more evidently including the sectors which were most hard hit during the pandemic, a trend that has been perhaps most palpable in the non-farm payroll statistics. Similarly, the US Fed toned down the implied economic risks from the virus in acknowledgement of the broad vaccine rollout in the US. The overnight policy rate OPR unchanged at 1.75 on 6th of May 2021, a decision much expected by the market. In the MPC statement accompanying that decision, latest indicators signal improvement in Q1 and April's growth. Core inflation to remain subdued to average plus 0.5% to plus 1.5% in 2021. Bank Negara has also acknowledged that high headline inflation, where the average is likely to reach 2.5% to 4%, primarily due to cost push factor of higher global oil prices. Headline inflation is also transitory, as it is projected to moderate thereafter as base effects dissipates. Echoing this stance of no interest rate change is Thailand, where Bank of Thailand has left its interest rate unchanged on 5th of May 2021 at plus 0.5%, which is already at record low for Thailand. Cited reasons by Bank of Thailand for a dovish tone resonated from risks arising from the new virus outbreak, slow vaccine rollout in Thailand, and also a weak SME sector. In conclusion, most central banks are likely to stay pat in terms of its course on interest rates in 2021. This should provide support for fixed income investments. We hope this podcast has been useful to you, and we would like to thank you for listening.